Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey from Wilsey Asset Management, president of Wilsey Asset Management. Great to have you here on the show today. We got many things to talk about. Obviously, on Friday, we had the jobs report, so we're talking about job openings post a sharp decline. And then jobs growth, well, still looks positive. We'll talk about that. Redemptions are high for climate mutual funds. We'll discuss what's going on there. And behind the curtain of private equity over the last few years become very popular because, quote unquote, there's no market fluctuation. It's posted like, oh, this is a great investment. We're going to talk about behind the curtain on that, what really is going on. Chase, what do you got?
Yeah, so companies we're going to take a closer look at today include Fox Corporation, PVH Corp, Dollar General, and also to UPS, or United Parcel Service, not the United Postal Service, the United Parcel Service.
Yeah, that's UP. What is it?
USPS.
USPS, and that's a UPS. That's kind of confusing, isn't it?
Yeah, I just realized that as I was saying that. But as always, we're going to take a look at those numbers there, give you our opinion on what we see for the valuations, the balance sheet, and let you know if we think it's buy, sell, or hold based off what we're seeing with our numbers.
Well, let's talk about the jobs opening posting a sharp decline. The Job Openings and Labor Turnover Survey, also known as the JOLTs report, showed job openings of 7.6 million in the month of December. This was below the estimate of 8 million and the reading of 8.09 million in the month of November. While this may sound disappointing, this leaves still the ratio of open jobs to available workers at 1.1 to 1. A softening labor market is still not a bad thing considering it is coming from such a strong spot.
Yeah, I mean, you have to remember here that workers have had an immense amount of power over employers for a couple of years, and that's starting to shift. I'm not saying that employers now have all the power once again, but there has been a shift away from the employees having so much power where they could get such great benefits. Everybody could work from home forever as long as they want. You get unlimited PTO. I think there's a lot of that benefit shift kind of coming back to normal. The Fed also, too, they want to make sure that the labor market isn't too strong as it could cause inflationary concerns. So I do see this as a positive considering it's still a good report, but not too strong. I still believe the labor market could soften further without it being problematic for the economy. And again, it doesn't mean that softening is declining, and you have to understand the difference between those two terms.
Yeah, still 1.1 jobs every person. That's still a pretty good number. One thing I did notice reading this past week about the quits number has been declining, and that's simply because employers don't need employees as much as they did. There's no point of paying a high salary to somebody to get them to move, so it's not a bad thing. It's just that the labor market is kind of settling in, saying, no, people are getting paid pretty well. We don't really need to offer a 10, 20% raise to come to us because we're sitting pretty good on the jobs.
Yeah, I mean, you look back, I think it was really like 2021, maybe beginning of 2022. The quits were just so high because people, they'd look at another employer and they could leave and get a huge benefit bump or a huge pay bump. And the days of that really seem to have dissipated. But it doesn't mean the economy is weak, doesn't mean the labor market's weak. It just, again, means it's normalizing, in my view.
And I do remember back then reading about tech companies saying, we don't need people, but we're going to go ahead and hire them because we couldn't need them in the future. And they were hiring people they really didn't need. And then that's why they had the big layoffs on them. Oh, well, I guess we didn't need those people, so they got rid of them. But that caused a lot of people to leave their jobs because, hey, they're going to pay me more to go there and then do almost nothing? Sure, I'll do that. All right, let's talk about the jobs growth. Still looks positive. The report came out on Friday. And although the non-farm payrolls growth of 143,000 in the month of January missed the expectation of 169,000, I still see the number as healthy for a growing economy. This number also came after revisions of 100,000 for December and November. The January number was slightly off the average of 166,000 in 2024, but I would expect to see a lower total in 2025, given the fact that unemployment rate is extremely healthy at 4%.
I was surprised. I would say maybe one of the negatives was that wage growth did accelerate to 4.1% in the month, which was higher than last month's rating of 3.9%. And also, too, it was the highest level since May 2024, when it also registered 4.1%. At this level, I wouldn't say wage inflation is problematic, but I would say it is worth watching. If it did reaccelerate to a higher level, that could pose problems for the battle over inflation. I would say overall, the job report looked healthy with no major surprises, and for the most part, it would point to a labor market that is, again, continuing to soften. There's a theme here, which I do believe is good for our economy as a whole. I think if the economy was too strong, that would put too much stress on the Federal Reserve, and that would cause issues for maybe we have to hike rates again. That would really spook the stock market if we did have to go down that path. So we do want to see the economy normalize, soften to a spot where the Federal Reserve can maybe even cut rates a little bit further. I think that would be the optimal case scenario where you're not having that concern over the Fed coming back in and looking at raising rates.
And Chase, I think the problem, the market did not like this news. I think it was because of the wage growth to the 4.1%. And the concern with that is that, okay, if you're making more money, you're going to spend more money. Therefore, too much money chasing too few goods causes inflation. But I think it's an outlier. I don't think we're going to see that again. I mean, there was no reason for it. I heard some pundits kind of talk about different things, which made almost no sense. I think they're just trying to talk to make sense of it. And just sometimes you get these strange numbers that pop up.
And sometimes, get this, the stock market will just go down. It
What?
just happens sometimes.
What? Why?
And there's no reason, there's no explanation. It just happens. So I'm not sure what happened on Friday, but yeah, I mean, we do know things are expensive, and even the strangest of news, like a small increase in wage inflation, perhaps could cause a slight decline in the market. I don't know, but I think it is important here too with wage inflation, and I want people to understand. I'm not saying that wage inflation is bad, and you think, oh, you just don't want people to be successful. No, you need to have a healthy amount of wage inflation, but you should have what we call real wage inflation. You could have wage inflation of, let's say, 5%. Sounds exciting, but if inflation's 6%, where you're losing purchasing power and it really hurts people that are maybe retired and no longer have a consistent wage coming in, the economy needs to see good, healthy, real wage inflation. And again, we risk if wage inflation spikes too much, overall inflation now spiking as well, it could actually hurt the economy much more than it helps the economy.
And what would be nice with wage growth is increasing wage growth is increasing production at a faster rate, because that means people working harder, producing more. That will not cause inflation because production's up. You're going to be fine. You have more to work with.
Yeah.
Less products or more products.
So, I mean, a number by itself, we always say, means nothing at all. You got to always kind of look at how it works in the grand scheme of things. And I think it's a little naive. I think a little silly to worry over this 4.1% level. I think wage inflation, and this is just kind of a blanket statement, but I think wage inflation around 4%, I don't think is going to cause inflationary concerns.
No.
The concern would be if it started to push back up towards 5%. It's like, ooh, that might put some pressure, because it's not just now people have more money to spend, which then is too much money chasing too few goods. That also means that companies are spending more for wages, which then maybe they have to increase their prices to offset the higher wages. Well, now they increase their prices. Yeah, that's inflationary.
Yeah, yep. And that's what we do in the Smart Investing Show. We have these reports. We go over the news for you, what's going on, then try to dissect it for you, make it understandable, and what the results could be going forward. So that's why
I did want to say we had a client come in, and he was looking at the government kind of offer to take the idea of not working essentially through September and then retiring in September.
The early retirement, I think they call them, or something.
Yeah, and I'm very curious because government has been a big addition to the jobs report, and I think they added somewhere around 33,000 or something again in the month of January, and it's consistently been one of the large top 3 contributors over the last year or so. I'm very curious how they'll account for that in the report, because if somebody takes the offer, they're still technically employed through September, I guess.
Yeah.
So does that mean in September, if let's say 100,000 people take it, is the government going to have a negative 100,000 to the payrolls, or is it going to be over that time as people take it, is that going to be a subtractor from the report?
I think it's going, and then when they are done, they're retired, they didn't quit or were terminated.
But the payrolls are still lower than they were.
Yeah. Well, that's what we're here for, to kind of look at it, and then we'll dissect it as it comes along, see what happens with it.
Yeah, because we would not have any reports yet that would have included any type of impact from that offer.
Yeah, that's true. They'll probably show up. Well, again, when they take the offer,
when they take the offer, does that impact payrolls, or does it show up in September? They do like just one fell swoop of everybody, and then it's like, oh my gosh, the payrolls look terrible in September. We'll have to see. There will be an explanation behind it, but just kind of, I guess, preparing people for that.
As it develops, we'll dissect it. We'll talk about it so you understand it. Let's talk about redemptions are high for climate mutual funds. Climate mutual funds, sometimes called green funds, grew quite rapidly from 2019 through the beginning of 2024. Now, apparently investors began realizing that the equity concentration in these mutual funds really hurt the returns in 2024. Redemptions of $30 billion means investors want to leave these climate-sensitive mutual funds to invest elsewhere. It is estimated worldwide that the climate-focused mutual funds are approximately $534 billion. Redemptions of $30 billion is a pretty big hit, considering that equates to around 5 to 6% of fund assets.
Based on how times are changing, I do believe going forward, investors should not expect their returns to keep pace with the overall market. Another problem for investors is when redemptions in these funds are high, the fund manager must sell off assets to raise cash, perhaps at lower prices, which can really hurt the performance of the fund going forward. This is because the stocks have been sold out of the portfolio to raise that cash, and let's say the stock does end up rebounding. Well, the fund performance will lag because of the missing equities that had to be sold. On the other side, if they sell positions with a gain, this will create tax consequences for investors that held these in taxable accounts. So a lot of times those redemptions, they could really ding you in more than one way.
Right. Oh, yeah. Yeah. And I've never been a fan of climate funds or anything for that matter. I mean, when we manage our portfolio, we're saying, what is a good business that's on sale? Can we buy it, and where it'll be 3, 4, 5 years from now? And I know some people want to be conscious of the economy, not the economy, but the environment and so forth, which I agree. But on the other hand, too, I think doing the climate funds or the green funds was just a fad, and I think we'll see it fade even more going forward.
I think they were really bad, and I say
How
that.
do you really feel? They were really bad.
I say that because I remember looking at it, and a lot of them chose to charge excessive fees in my mind. And you would look at what they held, and they would charge fees over 1%, and I was like, for what? Like, you're not getting any individual service from that. Right. They just charged a higher fee because I think it was a smaller group of managers, and they were almost all in cahoots with one another, and they would all charge these excessive fees for a product, in my mind, that was not superior. Yeah. And a lot of times you'd look and they would hold like a lot of the big tech funds, because big tech was always looking towards climate advancement, so they all own Apple, Nvidia, Amazon, the stocks like that, and you're like, oh, you're paying a lot to own the Mag 7, basically. Just buy the S&P 500 index at that point. But I think it was always quite silly in my mind, and I think they were the fad was used by the fund managers to charge excessive fees.
Yeah, and also to $500 billion. We'll see if they decline. I think they will, because I think the fad is kind of past, and there'll be some people that want to be green or want to be, environmentally conscious. And a lot of companies, they do that, but it just doesn't appear that they do that.
I remember these kind of started to grow in popularity even back in like 2016, 2017. And I'll never forget this. I looked at one, and their ESG, right, governance is what the G stands for. And one of the funds at this point in time held Wells Fargo. And I remember looking at it, and that's right after Wells Fargo had the whole scandal that they went through. And I was like, that's not very strong on governance. But it was in there. And I think if you want to invest because of your feelings over, ESG and the environment, I think you're way better off buying the individual equities that kind of fit towards your views, because that's how you're investing. I don't want to say the performance doesn't matter, but the reason why you're investing it, I think is more important. And I think by you buying an ESG fund, you may not even agree with all the companies that are within that. So at that point, now you're paying a higher fee and you don't agree with the positions. What's the point there?
Paying for something you don't really want.
Yeah.
So let's talk about behind the curtain of private equity. Private equity over the last few years has become the cool thing in investing. Investors have been trying to get into private equity as an alternative asset, which I personally don't believe in because of the behind curtain details that no one really knows what's going on. Over the last 10 years, private equity assets have increased 300% to around $4 trillion. What's even more amazing is that the fees collected by these private equity firms, get this number, has increased 600%. If you do the quick math, that's twice as much. A trade group by the name Institutional Limited Partner Association has had enough. They're pushing for new guidelines to standardize financial reporting for private equity investors, including private public pension plans, university endowments, and charitable foundations. What I thought was crazy is that private equity firms will vary how much they disclose to their clients, listen to this, based on how much they invested.
Wow, that's nice of them. And the thing I look at here is the small investors will get less information than the bigger investors, and that's, in my mind, a problem. In my opinion, it is just not a wise place to put your money, as I personally like to know what is going on with my investments. There are ways that private equity firms are enhancing returns by using certain types of financial engineering, as opposed to the old way of selling the companies they buy and returning cash to investors. The most revealing thing that I could find was the median fee. That's the median fee, the middle fee that the small investors pay is somewhere around 2%. I've said many times in the past, if your broker is trying to sell you or put you into the hot private equity market, I recommend saying no thank you and find a different broker. Maybe they're making a big fee off of it, a big commission off of it, but even if they aren't, I still don't think they're good.
And I'm seeing this more and more, and a lot of from your big brokerage firms, which, again, they've done this for years. I've been in the industry for 40 years. I've seen this over and over again. The big brokerage firms, you feel safe with them, but they're the guys that come out with these fancy products, and the reason why brokers like to sell them is because, quote unquote, there's no market fluctuation because they don't trade on a daily basis. I would rather take the time to educate our clients on how investing works than give you the false impression that, oh, everything is okay, because they don't do it just with private equity. There's private loans now, private. And then what really irritates me is that some of these brokers, they don't give a market value, don't know what it is. They kind of give an estimated value on the portfolio. Oh, this is worth this and this is worth that, when they really don't know because it's not up for sale.
Well, exactly. That's the big thing. It's not up for sale. And, we've had people where they need money.
Yeah.
When you don't expect maybe you need it, you can't get the money back. And that's the big problem. Is it you say, oh, yeah, let's say it's trading at $15 a share. It's not trading at $15 a share. If you wanted to call that stock position up today and get $15 a share, you couldn't.
Yeah.
You can't get access to the money. And that is why I will never do these, because I like to always have the option of getting out of something if something heads south. And the problem is things could go totally fine for these private equity positions, the private credit market. But if they don't and things head south, you can't get out. And that's the problem that I see, and that's the big problem why I wouldn't recommend, nor would I sell, nor would I personally do any of these private investments.
And actually, the thing they're done is because there's an easy sell. Oh, you're with Wilson Asset Management. Oh, they invest all in the equities. Oh, that's very volatile. Put in this private equity fund. Put in these private loans. You won't see the fluctuation. Yeah, you won't see it, but it's happening behind the scenes. It just irritates me because I'd rather sell something than educate the client on true investing.
And it drives me absolutely crazy when we take over a new client's investments and they have them in there because it's like, well, I don't want to work with that advisor anymore. It's like, well, great. We still have to leave that in there because we can't sell it. Yeah. So you're stuck in that one position. And like, what do you mean? It's like, yeah. They're like, I wasn't aware of that.
Yeah.
And they don't actually understand the details of that investment, and they're sold them. And I think that's just it's wrong in my mind, and I think it's something that people should at least know the details of what they're being sold.
Well, that's why we do this on the radio show. It's in the newsletter to help educate you on things to watch out for, because I've seen it, as Jay said, times where people are like, I didn't know that was the story on that. I can't get out of it. Nope, can't. Also in the newsletter, it is a free newsletter, goes out every Friday at 5 o'clock. Also talking about MicroStrategy has a $3 billion tax bill. DeepSeek monopolizes business stories. Europe has a Sikh economy. And then consumer buying a car would be hit hard by tariffs. And Amazon, I love this one. Amazon can't run a brick and mortar store. So that's all free in the newsletter. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And if you do have private equities or private loans, you got to sign up for it. You got to read that section on private equity. All right. I think it's just about time to talk about financial planning. For that, we turn to our financial planner, our CFP, Harrison Johnson. Harrison, how you doing today?
I'm doing well, guys. How are you doing?
Good. Talking about our 401k loans, a good idea.
So taking a 401k loan might seem like an attractive option. You can access cash quickly, but it comes with significant financial drawbacks, and that can make it a bad idea. So when you borrow from your 401k, you're essentially taking money out of your retirement. It's literally what you're doing, which means you're losing that potential investment growth and compounding returns, which is really crucial for your long-term wealth accumulation and ultimate retirement planning. Although you repay yourself with interest, the interest rate is usually lower than what your investments would have earned if you left them alone. And additionally, 401k loans have to be repaid, and usually it's 5 years or so you make payments out of your paycheck, and then if you leave your job either voluntarily or involuntarily, the outstanding balance becomes due. If you don't pay it, it's considered a distribution, which means it triggers income taxes, and if you're under age 59 and a half, you have an additional 10% early withdrawal penalty plus another 2.5% penalty in California, which that can result in a lot of taxes and further reduce your retirement savings. And then, moreover, the biggest drawback, in my opinion, when you repay the loan with interest, even though you're paying that interest to yourself, you are paying that interest with after-tax dollars, which means you're being taxed twice. First, you have to earn that money and pay taxes on it in order to pay that interest back, and then you're taxed again when you're withdrawing that money in retirement. So you're double taxed on those interest payments back to it. So many people also fall into the trap of taking multiple loans, which can create a cycle of dependency and derail long-term financial security. So while a 401k loan might seem like a convenient way to borrow, the risks of lost investment growth, tax consequences, and the repayment issues make it not a good idea to access.
And and I don't know how to say this, but I think it's called the average man. And again, that means men and women. I hear the talk like, this is such a great idea because you can pay yourself back. What a great idea. And you just destroyed that for those people to educate them. No, that's not the case. I guess it's the case, but it's the wrong case to really look at. You're paying yourself back. What a terrible idea.
Well, I think it's really disingenuous that they call it a 401k loan, because it's not a loan like a S-block or securities-backed line of credit. You are actually borrowing money and your investments are still growing. The big point that, again, Harrison made, it's not a loan. It's a distribution.
That's a great point. Yeah.
And it's the whole idea of borrowing money is to enhance your returns. This depletes your returns.
Yeah, it's a withdrawal. You're not penalized on that withdrawal as long as you pay it back, but you have to pay interest. And, whenever you borrow money, if you have a mortgage or you have a car loan or anything like that, you pay interest to a bank. And so with the 401k loan, okay, you are not paying interest to a bank, you're paying interest to yourself. But because of that, you are instead just paying taxes to the government. So do you want to pay interest to a bank, or do you want to pay taxes to the government? Because with a 401k loan, that's what you're doing, not to mention, again, that the money is not in there growing itself. You have to pay it back because it really is just a withdrawal that you're forced to pay back to yourself.
Well, I think, too, and I know you look at these numbers for your clients, but a lot of times people will say, I'd rather do the 401k loan because, as you said, I'm not paying interest to a bank. But let's say you take out a HELOC from your home to do home improvement. Well, that interest many cases is deductible. So your interest rate's actually lower. The overall impact to your financial plan could be far more devastating by taking money from your 401k loan than actually taking out a HELOC to do some home improvement work.
The interest is deductible, and again, you still have the house. So if the house appreciates in value, you get to keep that appreciation. With the 401k loan, you're taking money away from that investment, so any appreciation you completely miss out on.
I know when we have businesses that we do 401ks for, I push very hard. No, don't allow the loans. They're not a good idea. And sometimes we get pushback. I mean, Chase, you deal more with the clients on the 401ks. And I think a lot of times they push back because, well, the employees really want it.
Yeah, it's kind of one of those things. Once you offer it, you can't go back and not offer it.
Yeah, we try to educate the employees on that, but it's just so hard. I mean, people are so misinformed. Harrison, it's so great that you bring this up. And I like the tax part you brought up as well. There's so many reasons not to do these loans that are really distributions.
Yeah, the best way to think about it is your 401k, it's for retirement. Let the money stay in there, grow. Don't treat it as another source of cash for you to go buy, a car or a boat or, whatever it is, because there are really all these unintended consequences.
Down payment for a house. I've seen that one as well.
Yeah, and a lot of advisors even are like, oh, this is such a great thing with a 401k loan. You can borrow against
Who are these advisors? Where are these? We need to fire them.
Well, they're like, well, I'm not managing the money, so yeah, go ahead and take that money over there.
Yeah. Oh, yeah, exactly. Yeah, borrow against your 401k. Don't withdraw from the money that I'm managing for you. Or, realtors or broker or mortgage people will say that too. Oh, you've got a 401k? Yeah, we can make a down payment of that, and then you're investing. So that's great. You're buying this real estate that's so great. So again, 401ks, bad idea.
Yeah, I think it is, again, just a problem people don't think about. And if you use it to buy a home, I think you can actually stretch out that loan longer than 5 years, can you guarantee me you'll be employed with that same employer in 7-8 years? If not, that's where you could really run into issues. And I've seen people before where they're like, what do you mean I have a 10% penalty and it's taxable? It's like, yeah, it's just such a bad idea.
And I don't have the money. What am I going to do?
You pay the penalties, yeah. And then you have taxes, and then,
Yeah, now you've got a problem. Let's see, 20-something% tax on the federal side, 9.3 on the state, and then the other 10% penalty, 2.5% penalty. So it's like, yeah, that $50,000 distribution you took, you can't pay it back, so now it's become taxable. So you, number one, don't have it to pay it back, and now you also have $25,000 in taxes and penalties on that distribution.
Exactly.
And meanwhile, you were paying interest and being taxed on that too. So, again, lots wrong with it.
Yep. Well, Harrison, thanks for bringing that to light to people. We will see you on Monday. Again, that's Harrison Johnson. He is our financial planner, CFP. You have questions on that. We do not recommend the 401k loans. Give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. That's smartinvesting2000.com. You can send them an email and hook it back to you. All right, stay tuned with the second part. We'll be back right after the message. All righty, welcome back to the second half of the Smart Investing Show. We got 4 companies we're talking about: Fox, PBH, Dollar General, and UPS. We're going to kick it off with Fox, and I think we'll save after we do the numbers here because there's 2 classes of stock. There's Fox and Fox A. We're talking about Fox A. They are in the entertainment industry. High short on this, 12.8%. We do see that they have a PE ratio of 11.3 versus the industry at not material. And they're in the entertainment industry, by the way. Price of sales, 1.6 versus 2.5. Price to book value, 2.1 versus 3.5. Price of cash flow, 11.4 versus 21.6. And the PEG ratio going forward, 1 versus 2.7. So I'm not sure why the high amount of short on that, because the valuation ratios look pretty darn good so far. We do see the earnings over last year for Fox A are up 172.5% versus 99.8% for the industry. I think Netflix is in that industry. That's why it's such a high growth on the industry, I think. Sales, 4.3% versus 5.3%. The 5-year earnings per share growth rate from the analyst for Fox is 13.5%. not as good as the industry at 17%. We do see a dividend yield of 1%. They use 11% in earnings to pay that out, so that's safe. They could actually probably increase that dividend. We do see, let's see, on the balance sheet, current ratio 2.5, very good, very liquid because the industry is at 1.2, and the debt to equity is also very good, 0.7 versus 1.8. We do see a net profit margin of 14.4. That's very good. The industry is only up 0.4. Return on equity is 19 versus 14.2. Return on invested capital 13.3 versus 14.2. I'm not finding why there's 12% short on these shares here. But Chase, what do you got going forward?
Yeah, maybe people are thinking it's done too well and maybe it needs to take a breather because it has done well. I mean,
it's done well, but not that well. I mean,
yeah, it's not like big tech that's gone up tremendously. But I guess when people have that logic with other things, just not big tech. But looking at the current price here for Fox, and we're going to look at the A shares, so the ticker symbol is FOXA. It's $52.79. The 52-week range, the low here is $28.29, and the high, $55.56. The one-year return, what I mean here is it's up 79.1%, so it's done well over the last year. Yeah. The last 5 years of return has been a little, I'll call it lackluster. It's been okay. 5-year return, it's up 42.68%, and I say it's done okay. That's a fine return. It's not anything exciting, but it's still a decent return there. Going forward for Fox, we go out. They do report on a fiscal basis, so we're going to look at June 2026. I see estimated earnings per share of $4 a share. That gives us a target sell price of $66.40. So it would probably be in our hold category based off where it's trading now, but it's a decent estimated sell price. It looks like estimated gain would be about 26%. We like a 30% margin of safety, so we need a little bit more of a pullback to essentially justify a buy at this level.
Or an increase in earnings to pull up that target sell price. But looking at it, the range is pretty tight. I do see over the last 90 days, that's up about 6% on those earnings. So it's looking good. I still don't see why they're short on this. And maybe Chase has something to do with the two different classes of shares, which, again, we did not study this beforehand. And we did do on the newsletter. Again, that's why we tell people get that newsletter. It's smartinvesting2000.com. We did explain all these different type of shares that are out there. This one is a puzzler without looking deep into it.
Yeah, and that's the hard part is they have A shares, they have B shares. What comes along with those? You get super probably voting shares within that. I do see the Fox.
You said B shares. I don't see the B shares. Is that the Fox?
Fox.
So just Fox
A is the A shares. Fox is the B shares.
And it doesn't say B, so again, confusing, but it is the B shares if you see just the Fox. Okay.
Yeah. But I don't know which one comes with which voting rights, but I do see the Murdoch family, VA Family Trust, has about 40% ownership share in Fox, but they probably control more of the voting rights, I would presume, via the different classes of shares. And I got to say, I don't think I would ever buy a company like this. We've kind of been burned in the past by a company where we weren't able to vote on a particular concept, and it was extremely frustrating. And I think something like this, you'd hate to be part of something, and they do something silly, and, oh, sorry, well, we have most of the vote, so you can't do anything. And it's just kind of, I don't want to say wrong. It's their company. They started. They can do what they want. But as an investor, I don't know if I'd go down that. And I know the son, I think his name's Lachlan Murdoch, is now the CEO and running it. It looks like he's doing a fine job, but, it is staying within the Murdoch family.
Yeah, and I think if I remember from the writings that we did about the different classes of stock, I'm pretty sure the Fox A is one that the Murdoch family owns, and Class B is where they float it out to the rest of the people that you can participate in the earnings. You just can't participate in the voting.
Yeah. That's my assumption there. And obviously the reason I want to take a look at Fox was there's this little thing coming up this weekend called the Super Bowl.
What is that?
Yeah.
Super Bowl? Is that the...
But Fox actually has the rights to it this year. So I did see that their earnings are estimated to climb. And I'm assuming a lot of this has to do with Super Bowl because their earnings are estimated to climb about 26% this year. Then they are estimated to fall about 8% next year. because obviously they lose the Super Bowl rights. I forget where it goes next year, but it is a company that is still profitable. They have the broadcast. They still have the football rights. I'm not sure how long those go out in terms of the broadcast rights. I did see they are posting the Super Bowl on Tubi, which is
I saw that.
I was shocked by that.
So Fox is doing that on Tubi.
Mm-hmm.
The Tubi paying Fox for that? Must be.
No, Tubi owns Fox.
Oh, Tubi owns Fox.
No, I'm sorry. Fox owns Tubi.
Okay.
Yeah, other way around.
Yeah, other way around. Okay.
So I think it's I think this company has more to it than people realize. It's not just Fox News.
Yeah, which people think. And by the way, you do have a local connection because you're a commentator on Fox 5 News in San Diego. You've been doing that for 5-6 years now.
Mm-hmm.
Yeah, so that's your connection. But you watching Super Bowl this weekend?
I'm watching the Super Bowl. Of course I am. I'm going with the Eagles. Fly, Eagles, fly, baby. I do not want the Chiefs to win again. I like the Eagles, too. I think they got a good run game. They got a good defense. Saquon Barkley carried me to a fantasy football championship, won some money thanks to him. So gotta root for the Eagles for sure.
Yeah, I've liked the Eagles since I was I think 10 years old, so that's all I'll be rooting for.
They used to be like my second favorite team when they had Donovan McNabb and Todd Pinkston and T.O. when they were in the Super Bowl years ago.
Oh, so, I remember T.O.
Yeah. But, I definitely want to see the Eagles pull that out. I think they have a good shot. I mean, the Chiefs are obviously really good, but I think the Eagles can pull that out.
Real quick, then we'll go on. I heard that I think the Eagles have the biggest offensive line.
Yeah, they have a big offensive line. Yeah. They have a really, really good offensive line.
They said they got a guy that's 6'8" and 380 and can move like a guy that's 200.
Yeah, they got some great athletes on that O-line.
All right, let's go back to these stocks here. Let's talk about PBH, which is Prestige Consumer.
No, not B. V as in Victor.
Oh, I wrote it down wrong.
I was worried about that when we were going over it.
Well, you just got back from vacation, so, okay, PVH, there we go. Apparel manufacturing. I got the right one now, and it is just PVH, V as in Victor. Short is about 5.9%. They're in the apparel marketing industry, and actually it's Calvin Klein is actually who this is. They're just not, the name is not there.
And Tommy Hilfiger.
Tommy Hilfiger?
Yeah, Hilfiger?
I
don't know how you say it, but
I think it's Hilfiger.
Yeah, it's
not Hilfiger. Yeah,
it's HILFIGER. As you can tell, I do not wear that brand.
I don't wear that brand either. And Calvin Klein sounds too expensive for me. Although I think I do have a Calvin Klein suit now I think about it. Anyways, institutional ownership, 103%. That means from the shorts there. A good PE ratio here. This could start 6.5 versus 24.7. Price to sales, 0.5 versus 1.2. Price to book value, 0.8 versus 3. Price to cash flow, 5 versus 9.4. And staying in line here, the PEG ratio, 0.7 versus 9.4. So all the valuation ratios and the PEG ratio, very positive. Now, going back the past year, their earnings are up 13.5%. Not bad. Interest rate was up 16.8%. Sales for PVH did decline by 4.8%, but the industry fell by 5.3%. Wow, 5-year earnings per share growth rate going forward from the analysts, 9.8% versus 4.5%. So that's pretty good. I'm getting too excited here about this company so far. Dividend yield, 0.2%. Not too great on that. The industry's at 2.5%. Balance sheet, 1.3 on the current ratio versus 1.8. I'm okay with that. Debt to equity looks good, though, 0.7 versus 1.6. Net profit margin, 8.1%, almost double the industry at 4.5. Return on equity, 13.5 versus 18.9. Chase, I'm almost ready to buy this company. What do you got?
Yeah, so current price here for PV, and V as in Victor again, H. Current price here is $78.85. It's right near its 52-week low of $77.88, and the high here for the 52-week range is $141.15. The stock has not been a great performer. Over the last 10 years, it's actually down 27%.
Whoa.
Over the last 1 year, it's down 34%. So
and even year to date, down 25 year to date. It's only been a month.
I'll get to
Sorry.
that big
Did I take that away from you? I'm sorry.
No, you're good. But the valuations, as you said, they're phenomenal. I mean, you go out to January 2026, estimated earnings per share of $12.10. It gives us a target sell price of $200.86. It's trading at around 6.5 times those future earnings. The big concern with PVH is China.
Oh, of course. They a lot of stuff made in China with tariffs, or a lot of sales in China? What do they got?
Worse. China placed PVH on the unreliable entities list.
Ooh.
And this is kind of a relatively new law. So it's like, what does it mean? You know?
What you said, the unreliable list?
Unreliable entities list. So, and China could be using this as an example of what they can do to press their thumb on companies. It is, again, something that they started allowing a few years ago. And again, it looks like the government has wide latitude to take action against PVH, but it's not really clear what could happen. I mean, are they going to kick PVH out of the country? Are they not going to allow them to manufacture there anymore? Are they going to take over those operations? I mean, there's really wide latitude again on what they can do here. It says they can send its employees home if they're there on a work visa, so to speak. They can, nope, you have to leave now. and this is the problem with doing business in China. And China's not a large aspect of their sales. It's about 6% of sales, and about 16%, it looks like, of their earnings before interest and taxes. And this is from 2023. The bigger concern is it represents about 18% of production. So if they had to close down production there, they would not be able to be nimble enough to move all of that production to different supply chain areas. And then they could be forced to obviously cut sales. That'd be a huge hit to earnings. I don't know why China would do that. I mean, I don't know how you say that.
I said there's going to be a trade war. I mean, China is not going to lay down and say, okay, President Trump, we'll get whatever you want. No, they're going to do things that we didn't even think about. And this is kind of very surprising to me. And I forgot what you called it already again. It was a
unreliable entities list.
Unreliable. That's just a funny word. That unreliable for what? But I see the 52-week high is 141 down. I say what, 25%, $78 a share now. This could be what I would call a short-term problem, but a great long-term benefit, because the brand is still there.
Yep.
They're just going to have difficulties with China that could last, depending on how long the trade war lasts, 6, maybe 12 months. I mean, I see nothing else wrong with Calvin Klein.
Yeah, I think there's a lot of opportunity here, and it's just, you'd have to understand a little bit more, I guess, about the production, and they would not be able to shift 100% of that lost production in China. But
it's
China
12%, you said,
it's
right?
18%.
18%, okay.
So they would not be able to take all of that. But then, obviously, you're not selling into China anymore at that rate, so then all your outside production would then go to other areas across the world. And then if China just says, all right, you're out, I mean, shoot, that's a 16% hit to earnings. Let's even say earnings declined 16%. It's still a great value. I mean, I think there's some real possibility here. I don't love the China story, but it's trading at a very attractive valuation to account for that risk in my mind.
And I think this could be a good business on sale. And you got to set your targets longer term. It's not a trade. But I would think in 2 to 3 years, this will be over. And I tell people, I still remember in the 90s when I was doing this, it was shocking that Chrysler had some manufacturing, some production in China. And China said, no, we're done. Get out. Leave everything here. You leave. That's the power of China. And there's
what sounds like what they could do to PVH.
Yeah. And there's nothing you can do about it. Yeah. It's their country. And that's why I tell people, don't downplay China. They are very powerful. They can do many things. But even if they did that for PVH, okay, they could take their production to Vietnam. I think Thailand does it now. There's other countries there. They could fix this problem. And the stock's at 78. Maybe it falls to 50. But I think there's something worth looking at here.
Well, yeah, because you're so right. It's not like, oh my gosh, okay, we have to leave China now, it's all over. It's like, okay, so we lost 6% of our sales. That's the thing that'll be hard to get back. You can fix the supply chain. It just will take time.
Yeah.
The supply chain might take 2 to 3 years to actually fix, and you might have some higher costs because you had that business in China, but it's not something that would destroy and make PVH, Calvin Klein, go bankrupt.
Yeah, I think it's a pretty interesting story, and I think it could be an interesting investment, but a lot more research to do than that, but I think it's worth doing the research there. Let's move on to another company that's having some difficulties, Dollar General. Their symbol is DG. They're in the discount stores area. about 3.7% short on the float, 95% institutional owned. PE ratio 12 versus 40.9 for the industry, again of discount stores. Price to sales 0.4 versus 1.2. Price to book value 2.2 versus 9.2. Price to cash flow 5.1 versus 21.1. Unfortunately, no PEG ratio, but those valuation ratios look very attractive. Now, over the past year, you do see earnings have fallen by 19.7% for Dollar General. Industry was up 14.9%. Sales for Dollar General climbed by 3.8% versus a climb of 22.6% for the industry. They have a 5-year growth rate of a negative 2.1%. Industry's at 9.7%. We have a dividend yield of 3.3%. They only use 39% of the earnings to pay that nice 3.3% dividend. Looking at the balance sheet, current ratio 1.2, better than the industry at 0.9. Oh, shoot. The debt to equity, 2.4 versus 0.7. I was kind of getting excited about this, so I saw that debt to equity at 2.4. Net profit margin, 3.3 versus 3.0. Return on equity, 18.2 versus 23.6 for the industry. Chase, what do you got?
Yeah, so current price here for Dollar General, again, their ticker symbol is DG. It's $72.49, and this one, again, has not been a good performer. 52-week range, the low here, $66.43. The high, $168.07. I mean, just kind of looking at some of these returns, the last 1 year is down 46.4%. The last 5 years, it's down 53.2% over that time period. And looking over the last 10 years, it's only up 4.6%. So it's essentially been dead money for the last 10 years now. Going forward for Dollar General, though, we go out to, let's see the report on a fiscal basis. They do. We go out to January 2026. I see estimated earnings per share here of $5.93. It gives us an attractive target sell price of $98.44. I want to say I like it, but I don't think I'd feel good with it because of the high debt, and if tariffs come in and hit this company maybe harder than anticipated, really weakens that balance sheet further, it could cause potential bankruptcy issues down the line.
Yeah, I did look at the balance sheet. The debt is $15.6 billion. The equity is $7.3 billion. So that does worry me. And I'm disappointed because they had a good story. I mean, that their basic consumables like milk, eggs, cereal, paper towels, snacks, they account for about 80% of the sales. And what's great about them, a lot of people go to Walmart. Well, Walmart is about, from the nearest person on average, about 10 miles away. Their stores, I think, are like 100,000 square feet. A Dollar General is like 8,000 square feet. So it's very easy to go in there, get your milks and eggs and your basics. That sounded pretty good, but I can't get over that debt situation. I'm disappointed because I was going to say, yeah, let's put it on our watch list, but no go with that debt.
Yeah, I was just kind of looking to see if we didn't do any of the numbers.
And that's me tearing up the box sheet.
Dollar Tree, maybe we can look at it down the line. Dollar Tree's got a debt to equity about 138%. So even that's a little bit high. It's manageable, but a little bit higher than I'd like to see. But yeah, Dollar General, I think it's uninvestable for our strategy because of that high debt to equity.
Yep. We refuse to buy high debt companies. Doesn't mean the company will fail, but it's many times an uphill battle. Let's move on to another company that's a lot of companies have problems this week that we're kind of founding.
It's the best way to find good companies.
Yeah, I know it. And what we're talking about is UPS, which they reported earnings. I think it was last week. I think it was.
Yes.
Yeah. So let's talk about the numbers. I'm going to tell you the story behind it. UPS are located in the integrated freight and logistics industry. Not much short float there, 1.7%, 72% institutional owned. PE ratio now is 16.8 versus 19.4. Price to sales 1.1. That is above the industry at 0.8. Price to book value 5.8. Also more expensive than the industry at 2.8. Price to cash flow 9.6 versus 9.8. And the PEG ratio, very rare do you see this, it's 7.4. Above the industry at 6.7. And remember, you want a lower PEG ratio. We do see over the last year, earnings have fallen by 15.1%, which is the same decline as the industry. Sales fell by 0.3%. That is better than the industry decline at a negative 5.8%. 5-year growth rate for UPS, only 2.1% versus 5.5%. Dividend yield now, 5.8%. It does show they use 98% of the earnings to pay that out, but that is a nice, juicy dividend. Look at the balance sheet. Got a current ratio of 1.1 versus 1.4 for the industry. I'm okay with that. Debt to equity, another one, a little bit high. 1.6 versus 1. We get above 1.3, 1.4. We start getting a little bit nervous. Net profit margin 6.3 versus 4.2. Return on equity is very good, 33.6. Compared to the industry at 19.9. What do you got?
Yeah, current price here for UPS, or ticker symbol again, easy, UPS, $113.11. The 52-week range, the low is $109.40 and the high $158.95. I feel like we have a reoccurring theme here, as you said today, but the 1-year return is down 23%. I was kind of surprised by this, but the 5-year return is only up 9.69%, and the 10-year return, well, not very attractive there either, only up 11.47% over the 10-year period.
I do have to point out that does not include the dividends.
Yes.
The dividends make a whole different story. This company has been a dividend player. The 10-year return with dividends was 54.7. Not phenomenal, but not as bad as
Yeah,
the dividend.
again, this is why we talk about dividends really helping returns.
Yep.
Because you got a 5% dividend, I mean, that again adds up to about 50%. So I think that is interesting. And I was going to say, I remember looking at UPS a few years ago, and it's like, why is the valuation so much higher than its competitor FedEx?
Right.
And it just seems like, well now the stock's been dead money for the last 5 years. So this is, again, why you don't buy expensive companies. It doesn't pan out many times, no matter the name. I don't care if it's Apple or Amazon right now. It was UPS a few years ago, and now all of a sudden they've stumbled, and the returns have been very lackluster.
And we call it where the earnings have to catch up to the valuations or the stock price. And that's a very good example you point out here on UPS. For 5 years. It's been dead money because of the high valuations back 5 years ago.
Yeah. And I mean, going forward, I mean, this looks, I'm going to say, intriguing. The estimated earnings per share for December 2026 is $8.88. Gives it a target sell price of $147.41. So the valuation now is there for UPS.
Yeah.
Nobody wants it. Maybe it's time to look at buying it.
And the big problem that happened when they announced earnings, they're reducing and actually cutting, I believe, completely their contract with Amazon. And Amazon, that big name. And what they said was Amazon accounts for roughly 12% of the revenue. But the problem was they said it's not very profitable. And this is so important for a business. You can make all the sales you want, but you got to make a good profit on it. And they said they're not. I have mixed emotions. I don't have her first name here, but I think her name is Tomi. Do you have it there?
I want to say it's Carol. I
think you're right. I think it is Carol. And it looks like it's Tome, but there's that little thing on top of that E there. I'm not sure. You got it up there?
Yep, Carol B. Tome.
I just don't feel comfortable with her management. What is your thought? Do you have any thoughts?
I don't know enough about it. I think it's right on the Amazon contract.
Yeah, I agree with that.
I think that's good. I know they've had to deal with union pressure as well. I think she's had a lot to deal with the last couple of years. What's been her tenure? Do we know?
I do not know. I didn't have that information. I don't know if you can find it quick or not. Yeah. But I mean, just things I've kind of read. And I know the union doesn't like her. I don't think the employees like her. I think I would not be surprised if a year from now she's gone.
Yeah, so it looks like she was CEO June 1st, 2020 to current. So she's had a rough period.
Yeah.
But is the rough period because of her? Or was she just in the wrong place at the wrong time? And I don't know. I think sometimes with a company like UPS, when it is struggling, a new CEO would be like kind of using a scapegoat, essentially. It's like, well, it was her, so you bring in a new CEO, and it looks good on the face value, so then that stock maybe gets a lift because now there's excitement around it, and it's, out with the old, in with the new. Maybe that'd be something valuable of UPS, but I do like that they're getting rid of the Amazon contract. I think Amazon's been able to use its power to again, get favorable contract terms from themselves, and I think they kind of saw with FedEx exiting a lot of Amazon deals, and they were able to enhance profitability. Maybe they can go that same route.
Yeah, because FedEx has done far better than UPS, and I think because of that reason they said goodbye to Amazon. I think it was 2 years ago? It's been a while.
It's kind of been a slow bleed, I'll call it, where they cut this with Amazon, cut that with Amazon, and when they cut it, they just didn't really opt to go for a new contract.
Right.
So I don't know how UPS did it, but
It looked, from what I read, it wasn't a whole lot, but what I read, it looked like it's a quick cut, like we're done. We want to cut this contract as quick as possible because they're just not profitable. And I think
it's so weird because FedEx didn't go after the USPS contract,
right?
But UPS got it, and FedEx is like, it's not profitable. So it's like,
did Carol Toomey do that?
I assume so.
Maybe she likes non-profitable.
She's like, okay, we chose USPS. We're not going to do the Amazon anymore. We're trading out one bad deal for a different bad deal.
Yeah, I want to like UPS because I think there's some things there, but you got to do a lot of reading on it. I do feel strongly that within a year that CEO will be gone, and maybe not all her fault, but through a difficult time, she's not done a good job.
Yeah. I think, I don't think she's done a terrible job, but I don't know. I don't know enough, I guess, about what she's done and kind of what's been on her plate. I've just noticed that UPS has not done well from a stock perspective lately.
Yeah, and there's UPS employees that have a lot of their stock. They're not very happy. So, all right. Well, thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. That's smartinvesting2000.com. You can listen to the podcast there. You can sign up for the newsletter. You can send us an email. A lot of great things there. Again, at smartinvesting2000.com. Thanks for listening. We'll be back next week right here on the Smart Investing Show.
To think that I did all that